Have you ever wondered how a real estate investment trust can transform a country's retail landscape while adhering to global investment norms? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. CapitaLand's groundbreaking listing of the CapitaLand Commercial Real Estate Investment Trust, or C-REIT, on the Shanghai Stock Exchange marks a pivotal entry into China's high-growth onshore retail real estate market. As the first international-sponsored retail C-REIT in the country, this move aligns global capital with China's domestic infrastructure goals, creating a unique investment opportunity. The C-REIT structure is designed to bridge the gap between international real estate investment trust standards and China's regulatory environment. By securing a 20% strategic stake through CapitaLand Investment Limited, CapitaLand China Trust, and CapitaLand Development, the C-REIT ensures operational continuity while adhering to China's stringent 28.6% leverage cap. This is significantly tighter than the 50% limit for CapitaLand China Trust, reflecting a disciplined approach to debt management that aligns with global real estate investment trust norms. The initial portfolio includes two high-occupancy retail assets, Capita Mall SKY Plus in Guangzhou and Capita Mall Yuhuading in Changsha. These properties, with a combined gross floor area of 168,405 square meters and a 97% occupancy rate as of March 2025, are anchored by diversified tenant bases. This mix is critical in an era where e-commerce pressures traditional retail, as it drives foot traffic and enhances tenant retention through experiential retail diversification. China's 2024 C-REIT reforms have expanded eligible asset classes to include offices, hotels, and senior living facilities, provided they are co-located with qualifying infrastructure. By removing minimum yield requirements for sponsor-owned properties, these reforms reduce entry barriers and enable real estate investment trusts like the C-REIT to prioritize asset quality over rigid return thresholds. The rapid growth of the C-REIT market, projected to reach $500 billion by 2030, underscores its appeal to both domestic and international investors. Infrastructure real estate investment trusts have outperformed traditional property stocks by 12% in 2024, trading at an average price-to-book ratio of 1.4 compared to 0.25 for developers. This valuation premium reflects confidence in real estate investment trusts' stable cash flows and environmental, social, and corporate governance credentials. For global investors, the C-REIT represents a unique opportunity to access China's retail real estate market without the complexities of direct ownership. Its alignment with CapitaLand Investment Limited's domestic-for-domestic strategy reduces exposure to foreign exchange risks and regulatory hurdles. Meanwhile, domestic investors benefit from a platform that offers liquidity and diversification in an otherwise fragmented market. In Sacramento's North Natomas area, a new application proposes adding retail buildings and an additional office building to the existing commercial development at Truxell and Del Paso roads. The development, known as Centerpoint at Natomas Crossing, is undergoing a new phase that reflects evolving demand for certain types of commercial properties. This phase indicates a shift in the commercial real estate landscape, where mixed-use developments are increasingly favored. The plans for Centerpoint at Natomas Crossing are part of a broader trend towards integrating retail and office spaces to create more dynamic environments that attract both businesses and consumers. This approach can enhance the appeal of commercial developments by providing amenities that cater to diverse needs, thus fostering a vibrant community atmosphere. The proposed expansion at Truxell and Del Paso roads highlights a strategic move to adapt to current market trends, where flexibility and multifunctionality in commercial spaces are key. By adding retail components, the development aims to increase foot traffic and provide additional conveniences for office tenants, ultimately enhancing the overall value of the property. This trend is not only limited to Sacramento, but is also seen in other parts of North America. In cities like Kitchener-Waterloo, London, and Cambridge in Ontario, Canada, there is a growing emphasis on mixed-use developments that combine residential, retail, and office spaces. These Canadian cities are focusing on creating urban centers that support both living and working environments, driven by a need to optimize land use and cater to changing consumer preferences. Similarly, in the United States, urban planning increasingly favors developments that integrate various types of real estate to create cohesive community hubs. This cross-border relevance underscores the importance of adaptability in commercial real estate as developers seek to meet the demands of modern urban lifestyles. In Mesa, Arizona, a new development promises to transform the landscape with a massive mixed-use project. Vestor, in partnership with Pacific Proving Limited Liability Company, is set to develop Legacy Park, a multi-billion-dollar urban oasis that will seamlessly blend high-end retail, corporate campuses, and outdoor amenities. This ambitious project aims to create a vibrant community space that caters to both local residents and businesses. Legacy Park is designed to be more than just a commercial hub. It is envisioned as a dynamic community center that integrates various elements of commercial real estate. By combining retail, office, and recreational spaces, the development seeks to foster a lively environment that supports diverse activities and interactions. This approach reflects a broader trend in commercial real estate towards creating spaces that serve multiple purposes and enhance community engagement. This development in Mesa is part of a larger movement across North America, where cities are increasingly favoring mixed-use projects that combine residential, retail, and office spaces. In Ontario, cities like Kitchener-Waterloo, London, and Cambridge are also embracing this trend. These Canadian cities are focusing on creating urban centers that support both living and working environments, driven by a need to optimize land use and cater to changing consumer preferences. The cross-border relevance of these developments underscores the importance of adaptability in commercial real estate. As urban planning evolves, developers are recognizing the value of integrating various types of real estate to create cohesive community hubs. This adaptability is crucial in meeting the demands of modern urban lifestyles, where flexibility and multifunctionality are key to attracting both businesses and residents. According to a report from CNBC, commercial real estate activity is beginning to show signs of recovery after experiencing a slowdown earlier this year. The latest bid intensity index from JLL, which measures liquidity and competitiveness in private real estate capital markets, improved in July for the first time since December. This signals a positive shift in the market dynamics. JLL indicates that institutional investors are returning with more capital as borrowing costs and valuations stabilize. This influx of capital is helping to narrow bid-ask spreads, which is the difference between the highest price a buyer is willing to pay for an asset and the lowest price a seller will accept. This narrowing is particularly evident in multifamily, student, and senior housing sectors. While the retail sector has seen improvements since last year, it still faces challenges due to tariff pressures. On the other hand, the industrial sector continues to experience sluggishness amid ongoing supply chain concerns. However, there is renewed interest in the office market as the return to office momentum gains traction. Commercial real estate is on the brink of a technological transformation, and 2 Stanford University graduates are at the forefront of this change. According to Rico Franco's article published on August 27, 2025 in Tech Times, Anmol Tukral and Chinmay Patel, both Stanford alumni, have taken a significant step in modernizing the commercial real estate industry through their startup, Closera. Backed by Y Combinator, Closera aims to revolutionize how property marketing is conducted by utilizing generative artificial intelligence. The commercial real estate sector in the United States is projected to reach a staggering $25.79 trillion in 2025, with transaction volumes estimated at $757 billion in 2024. Despite these impressive figures, the industry still relies heavily on manual processes that are ripe for modernization. Brokers continue to draft offering memorandums by hand and create brochures from scratch, spending over 30 hours weekly on administrative tasks that could be automated. Closera addresses this inefficiency by replacing entire days of manual, repetitive work with AI-driven execution. Their platform drafts offering memorandums, generates polished brochures, and stages properties virtually, all tailored to the property and its target audience. This approach not only enhances human creativity, but also eliminates routine busy work, allowing brokers to focus on high-leverage tasks that truly set them apart. What sets Closera apart is its sophisticated approach to context. Unlike generic marketing automation, Closera's proprietary AI agents use generative models combined with context-aware inputs from property data, photos, and client preferences. This ensures that the outputs are adapted to match target audiences and listing types, which is essential for high-value commercial real estate transactions, where excellent marketing execution can ensure million-dollar deal success. The impact of Closera's platform is already evident, with brokers at several major brokerages reporting accelerated deal flow and enhanced output quality. By automating routine tasks, brokers can handle more listings while maintaining exceptional presentation standards, which is particularly valuable for high-value transactions where timing often determines success. The transformation that Closera brings to the commercial real estate industry is akin to the disruption seen in digital publishing and e-commerce. By democratizing capabilities that were once reserved for large firms, Closera enables smaller firms to compete with industry giants. This shift in competitive dynamics is significant, as it allows individual brokers to scale their output while maintaining quality excellence. As the commercial real estate industry continues to evolve, the adoption of artificial intelligence will be crucial in gaining a competitive edge. With most major firms already mandating AI adoption, the ability to adapt quickly to technological advancements will determine success. Closera's platform is helping the industry navigate this transformation, one AI-generated marketing piece at a time. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.